So the preamble to this was the idea that because we're in shelter in place, is a good chance for a lot of us to kind of focus on some of the stages that our businesses are in and make sure that we're on solid financial footing, when things start to open back up. And so the conversations that I had with Chris and Daniel were around what are some of the things that you guys might be able to make us aware of, and what stages we should be in before we start thinking about them. So Chris and Daniel were grateful and giving enough to kind of put together this presentation here. And yeah, with that, I'm going to pass it off to Daniel and then Chris.
Perfect. Thank you. And thanks all for taking a few minutes to be with us today. As Chris had mentioned, my name is Daniel Byrd. I joined with my business partner, Chris Lesueur, and we're financial advisors with Equitable. My specialty is investment strategies for new industries, helping a lot of clients identify exciting opportunities in the fourth industrial revolution, where Chris Lesueur does a ton of management work with startups. And as Chris Meyer was highlighting earlier, the goal for today is just to introduce a couple of business controls that are often requirements for many of our clients in their early stage investments. All along the way, promise to provide a few real world examples. And before I turn it over to Chris, just wanted to note it's probably going to be best for the sake of time to hold questions to the end, but just know that we're happy to chat one-on-one after.
Yeah, and for the Innovation Fund members, we are going to be, both Chris and Daniel are going to be in the Slack channel. So you can either DM them or in the events channel itself. We'll be answering some questions there.
Yeah, no, absolutely. Alrighty. Well, with that, thanks for taking the time. I will flop over here so you guys can hopefully see the presentation, and we will jump right into it. Switch this. All right. Can everybody see that?
Yep, looks good.
Fantastic. Well, thanks again. As Dan mentioned, we're financial consultants with Equitable Advisors. Today, our kind of main topic that we're going to go over is buy-sell agreements and what they are valuable to earlier stage businesses and how they can really benefit you later on, and some few other details that we'll go through in the presentation. With that, as Dan mentioned, my specialty is around business strategy, whereas Dan, my business partner, he really focuses on new industry, and there's a lot of kind of strategy that we can put together there that matches between what you need to do to make sure you have a functioning operational business, but also make sure you're still driving forward innovation and new technologies and all that fun stuff that you guys do over here at SolderWorks. So jumping into that first topic that I want to cover is just what is a buy-sell agreement for those that may not know. And essentially what a buy and sell agreement is that it's just a legally binding contract between business partners that essentially will dictate how a business partner's share of a business will be reassigned if something were to happen to that partner, whether it's a death of a partner, the partner of the business retires, there's a bankruptcy, or there's some aspect that requires a partner to leave the business. And if that partner of the business is a huge contributing member, that can leave a pretty substantial financial impact, especially if it's an unexpected circumstance. Other ways that people might know a buy-sell agreement is they might call it a buyout agreement or business will, or even some people even call it a business prenup. Essentially, the way they work is they're commonly used by a sole proprietor or partnership or close corporation, and it's really just supposed to help smooth the transition of ownership in the event that a partner leaves the business for whatever reason. And also the other key thing is to make sure that there's funding in place for that agreement to make that buyout or transition happen. Usually it requires either the partnership be sold back to the company, or it's going to go according to a predetermined formula that will be sold to the remaining members. Jumping into the kind of common types of buy-sells that we probably see, the most common we probably see are these three types, which is a wait and see, an entity purchase, and a cross-purchase buy-sell. With some of these models, you can definitely tell that they can get pretty complex with how they work. And one of the beautiful things about a buy-sell agreement is that it's very scalable for where your business is and where it could go in the future. The one I like to talk about most commonly is that kind of wait and see purchase method. I think it's just one of the most optimal ones that a business can put into place. Really what that one does is saying, look, you're coming up with an agreement between owner A and owner B that there is going to be a buy-sell agreement put forward. But unlike other buy-sell agreements, it doesn't identify who the purchasers of that company are going to be until a triggering event occurs, whether that triggering event is a retirement of a business partner, disability of a business partner, death of a business partner, etc. It gives you the flexibility of saying, okay, there's no one that's forced into having to make the purchase of the company, and that person who's going to be the purchaser can be identified at the very end, or when that triggering event occurs. However, it does ensure that you have funding and some sort of mechanism in place that everybody has agreed to beforehand. The entity purchase model is a little bit more of saying you're just going to sell your shares back to the business. You usually see this in larger companies when they get to executives of Fortune 500 companies per se. What they're going to do is they're going to go ahead and say, look, I'll just sell back my ownership stake to the company, and the company can decide what to do with it from there. And then that way, no individual partner is having to face the financial burden of buying that other person's share in the company and having to figure out how to fund that. The last method, which usually we see among partnerships, is a cross-purchase method, where essentially what you're going to do is you're going to create an agreement with your business partner, and you basically are going to say, hey, if something happens to you, I want to buy your share of the business so that way I can keep the business going. And if something happens to me, I want you to be able to have the same right to purchase the business from my estate. And those are probably the most common that we see across the different types of business models. So you kind of see how it can be very scaled. Across purchase, you see very small businesses, typically 2, maybe 3 partners. The entity purchase, you see along large corporations with numerous partners. And then the wait and see is you typically see for mid-sized businesses that are unsure what their exit plan is going to be and who the purchaser is going to be at the end of the day for the business. Jumping into there, why, it's great to know about a buy-sell. It's great to know what it is and that it's important to a business, but why would you want to utilize one? The most common things, these are probably the most common 5 reasons you want to use a buy-sell agreement. One is to create a market for your business interest. In case of a certain triggering event, whether it's a retirement and you say, hey, I've run this business for the last 30 years, I'm ready to retire and I want to sell it to my business partner. Or there's a traumatic event that happens like a death or disability that's going to put you in the position of saying, okay, now we're up against a timeline and saying, what are we going to do with the business? What are we going to do with this person's share of the business? And how is that transition going to function? And is that transition even going to be smooth? So first and foremost, it creates a market for that business interest. The second thing it does is that it smooths the transition to management and the control to the surviving remaining owners of the company. So that way there's the least disruption to the company in case a triggering event were to occur. The last thing you want to do is have to halt all business and try to figure out what are we going to do now that there's some sort of triggering event that's happened in our company. Next thing is to make sure you provide something that's mutually agreeable among everyone, right? You don't want to avoid litigation, and you want to avoid litigation. You want to avoid friction between business partners. Because the last thing you want to do is be hurting relationships with your partners, getting into lengthy lawsuits about disagreements within the company, and overall a bunch of things that are just going to have a much deeper financial impact to your company. That may drag that process on longer than you need it to, and be a big disruptor. The last thing is it's very useful to help establish a valuation for your business, which can apply for estate tax purposes or for other tax purposes. And the last one is to provide the family of the business owner with liquidity, so that way that way they don't end up with some sort of non-marketable business interest. The best example I like to use here is there's a company a while ago that it was a chiropractic firm that the husband, her husband, who was the owner of it, he ended up passing away unexpectedly. And if they did not have a buy-sell agreement in place, she would have been stuck with a chiropractic practice with 1,200 clients And she's not a chiropractor. She doesn't know how to run the business. She frankly knew nothing about the business. And she would have been stuck with this kind of, to her, a non-marketable business where she's like, I wouldn't even know the first place or the first person that I would sell this to. Luckily, they had a buy-sell agreement in place, and that was able to then transition the ownership of the business to the remaining partner, who was also a chiropractor that knew the business inside and out, was able to run it and take care of the clients. And the spouse of that deceased owner, she was able just to receive the liquidity, the money, the value of his ownership in that company, and left them on great terms, and kind of provided a legacy to her in a way. Dan, do you have anything to add on what I've gone through so far?
No, I think you really drove the point home with that real world example, and it doesn't have to be an exotic industry, or these are just standard programs and controls that you can have in place that make sense to really look at this point in your business before you get too far along, because at some stage you're going to either need to entertain rounds of investors or potentially even an acquisition. And for the clients I work with, they want to make sure that you have thought through these areas of your business too, especially in light of everything that's going on in today's world.
Yeah. And I think one of the key points
to re-articulate some of this stuff. So for early stage startups, the biggest benefit of having the conversations around, these events is just making sure that you're all in alignment. And then on the investment side, it's ensuring that, those that are potentially going to contribute to your business, they have some confidence that you have these agreements in place. Is that kind of a good synopsis there from an early stage company perspective?
Yeah, absolutely. From an early stage company perspective, that's exactly right. Is one, if you're looking for potential investors, they're going to want to know that you have these type of controls in place. They're going to want to know what happens because your investors are going to go, we don't know how to run your company. But we want to know that there's a contingency plan in place, that if something were to happen, that the company is able to go on, and that there's that risk of their investment is controlled. So that's definitely very, very accurate, and it's very necessary for early stage companies to consider an agreement. And to the point that we made earlier, I mean, you want to talk about these things while the relationship is good, right? You don't want to wait until something traumatic or something happens and then all of a sudden last minute try to negotiate an agreement, because at that point there, you don't know if everyone's going to want to participate or negotiate the same side of the agreement, and it can cause a lot of friction among business partners.
Yeah, emotions are high. Reason is low. Not a good time to scramble together an agreement.
Yep, and I just wanted to emphasize this is a good way to at least breach the topic in a way that doesn't make it seem like you're trying to be greedy early in the business. So making sure that you have agreements with your partners is one of the best things that you can do for ensuring that you survive.
Yeah, exactly. And it's, it's just going to cause you, I mean, how many times have we seen it in the movies or something like that? Somebody makes it big, and all of a sudden they have all this cash, or company's doing great. They feel like they're on top of the world, but then the inevitable disagreement comes down to it saying, oh no, I did more work here. Oh no, I did more work here. Oh no, I own more of the company. This is how much I deserve to have. A buy-sell agreement is a very non-threatening way to say, hey, let's just put an agreement between each other saying, this is what we're putting in, this is what our value toward the business is worth, and this is what we're going to have. Whether you negotiate it as a 50-50 agreement or not, it's something that you can at least be confident in knowing that you have some sort of mutual understanding to how you're splitting the value that you've driven in your business. Jumping into the kind of next section that I want to talk about here is the funding of a buy-sell agreement. At the basis of a buy-sell agreement really is just a legal agreement a legal contract between you and your business partner. There's no inherent funding mechanism behind a buy-sell agreement, because all you're really doing at the end of the day is agreeing on mutually agreeable terms to sell the business. There's not really a mention in there saying, oh, you're going to buy it through X, Y, and Z method, or how am I how are you going to come up with the cash to do that? Because I imagine not a lot of us are able to go and say, oh, if my business is valued at $1 million and we're going to split it 500K, and something happens to my business partner, am I just going to be able to cough up 500K in cash to buy out his share of the business? And a lot of us are not going to want to be able to do that, or even want to sacrifice that liquidity if we have it. So there's a lot of methods that we can use to fund a buy-sell agreement that provide little drag on the business, and ensure that you're able to meet those obligations if and when you have to. So to kind of talk through some of the funding mechanisms that we utilize, one of the top ones we see in early stage businesses is definitely life insurance. One, you can use the cash value of life insurance to fund any short-term needs to the buy-sell agreement. And then if there were something that is traumatic that happened, you could use different benefits like an accelerated death benefit or even death benefit in general to be able to cover that buyout cost for a partner. Other ways that we see people do it is they establish a sinking fund, and that sinking fund is either going to hold some sort of fixed investment or equity investment that will grow over time and stay in line with the valuation of the business. Other ways people do it is they do an installment sale, self-canceling installment note, or even I've seen circumstances where people have used a private annuity to fund their buy-sell agreement. The absolute worst thing you can do is have no funding behind it, because you don't want to get to the point of having to execute your buy-sell agreement and then all of a sudden going, oh, sorry, I can't hold up my end of the bargain because I don't have any funding or any cash in the bank to cover this. And that could be another stress factor, another friction point in a relationship of saying, look, we agreed to this and you don't have the funding. You're obligated to buy these shares from me. And it's one of those arguments that is futile that you don't want to get into with your business partner. And then the last,
sorry, I didn't mean to interrupt here, but I'm curious, like what stage? Oh, a little bit of echo here. What stage typically is a company at in terms of revenue, where they start to put an investment around these types of things?
Yeah, so typically when we see, I've seen companies doing 500,000 in revenue have a buy-sell agreement, and those sort of companies, it's usually a pretty simple agreement of just saying, look, we're just going to do a cross-purchase plan where we're going to buy life insurance on each other, and if something were to happen, whatever the case may be, we're just going to take that benefit, and that's going to be the way that we can purchase each other's shares in the business if and when we have to. Now, the larger your business grows, the more complicated that conversation gets, because you're considering things like retirement. You have other key employees of the business that need to be included in there. Like you bring on somebody who's maybe not an owner of the business, but they're a chief engineer, and their contributions to the business are valuable enough that if you were to lose them, either to another competitor, or disability, death, whatever that triggering event may be, bankruptcy even, what's going to be the financial impact to the business. So typically I see it as small as companies doing about 500,000 in revenue start to consider buy-sells and start to implement. And then as time goes on, they typically revise it. And you typically don't see sinking funds or private annuities and those other funding mechanisms until a business is over $1 million in revenue.
Cool. That's a helpful threshold for some folks to think about these things.
Yeah, absolutely. So 500,000 in revenue is definitely when you want to start considering this, and just maybe even putting something really simple in place of just saying, okay, what are the major risks associated with the business, and what can we ensure and provide some sort of risk mitigation against. And then as it goes on, go back and reevaluate this plan. And maybe you don't have to do it on an annual basis, but maybe every other year, go back and reevaluate your buy-sell funding plan and determine, is that accurate? Because the next thing you're going to want to consider is, what is the valuation of the business? The way you value your business today, I guarantee you, is not going to be how you value your business in 5 years or 10 years. And so you're probably going to have to update that valuation. And as you do that, you're probably going to have to update your funding mechanism as well. And that provides a nice little... Yeah, and that provides a nice little transition into what I want to talk about next was valuation. And as an early stage company, how do you determine what the value of your business is, and how do you incorporate that into a buy-sell agreement? Um, so below here, I've got about 3 methods that we commonly use to value a business. And I'm not going to say any method is preferred or better over another. Every business is different. Every agreement is different. And it requires a different way to evaluate that and determine the valuation of the company. But if we go back to what the purpose of a buy-sell agreement is, it's just to establish a peaceful process for a transfer of a business. But the most important aspect of it is the valuation of the business interest. And how much is everyone going to get by purchasing my partner's share? How much am I going to have to spend, and how much are they going to get? And is that a fair price? One of the the 3 most common ways we see people do that is either through an appraisal, a fixed price agreement, or some sort of formula. Now, the appraisal is fairly simple. Basically, what that's saying is that you're going to go out there, you're going to find a professional like a lawyer, an advisor, a CPA, someone in the financial field that's going to be qualified to come in and provide you a valuation on your business. And they'll take all your financial statements, documents, sales numbers, all that sort of stuff into account, and they will come up to you with what they think is a fair appraisal of your business. A fixed price agreement is just going to be something of saying, look, I usually see this in earlier stage companies where we go, okay, each of us made a $100,000 investment into the business to get this project going. And because of that, we're going to come up with our initial fixed price agreement to say, look, we're going to pay each other $150,000 to buy out each other's shares. So that way you get your investment back plus a little bit of the profit that we've earned. And that's a fixed price, and it's not going to change. So if you don't want to update that agreement and you go 10 years down the road and you're no longer a small startup anymore, and now you're doing $1 million in revenue, well, then that may not be a fair price, and that's something that you may have to go back and reevaluate. But this is a really critical way of saying, look, this is a way to ensure against if something were to happen to you, you can recoup your investment from the business. And the business partner is then able to acquire the shares of the business and can keep the business moving and rolling in a positive direction. The last and probably the most complex method we see is when a business starts to reach a critical scale, probably above that $1 million in sales, and they need to go, okay, we need a more dynamic way to value our company. One, it's not realistic for us to pay somebody to come value and do an appraisal every year. We don't want to spend the money doing that. 2, a fixed price may not be accurate of what our business is actually worth. So the last thing we're left with is coming up with some sort of formula method that's going to determine the value of our business. And I've concluded about five examples here of what that may look like. For some companies, it makes sense to take your balance sheet assets minus your liabilities and add 1/2 accumulated depreciation. Other businesses, that may not make sense. Some businesses like to keep it simple and just say, look, I'm going to do our buy-sell agreement is going to be based off of a valuation of 2 times our accounts receivable on the date of the sale. And it's really up to you and your partner to determine what's going to be the most accurate. One thing that I would caution is don't get into a one-track mindset of going, okay, I want my business to be worth $1 million. Therefore, I'm going to set a fixed price agreement of $1 million and leave it there. Be a little bit dynamic and be a little bit flexible in how you're considering the value of your business. And don't be afraid to look at what the other avenues look like and figure out what really describes your business the best. Is your business best valued off of your accounts receivable? Is it best valued off of your gross sales? Or is it best just to have somebody appraise every 5 years and determine that value for you? That's really something that you want to have an open and honest conversation with your business partner about. So that way you're both on the same page on how you value the business and how you're determining where that business is depending on its life cycle, and be flexible in going back and revisiting and reevaluating it. So that way you always have something that you feel confident is a fair price for the business and the hard work that you put into it. Dan, do you have anything to add?
Yeah. No, great job, Chris. Spot on for the different approaches. And the only thing I would add there is that these are also the most common approaches that professional investors will use for business valuations. So depending on the stage of your business, it does make, as Chris was pointing out, one method may make a lot more sense than another, and just know that you need to have that flexibility to transition over time, because the different investors that you may be working with at different stages may have different valuation approaches, and you just need to be prepared for that. Absolutely.
The next kind of thing I wanted to cover here, this is just a sample of what.
Sorry, before we get started in the next part, we're about at the 10-minute mark. I don't know if you wanted to burn through the next bit and open time for questions, or.
Yeah, no, absolutely. Let me I'll cover the next couple slides real quick, and then we'll open it up for questions.
Cool.
The one thing I just wanted to cover here, this is just a resource that we use with our clients when we review their buy-sell agreements. Even if you don't already have one in place, this at least we're happy to provide this PDF. Everyone, you guys can take a look at it, maybe work through it yourself. But it does give you some valuable information of saying, okay, when you're reviewing or maybe initially getting into formulating a buy-sell agreement, these are some things that you're going to have to consider, and some critical numbers and documents that you might need to have on hand when you enter into that conversation. So definitely let us know if anyone wants a copy of this. We're happy to provide it to you. And it's just a good resource to use as you start to explore that buy-sell conversation. The last bit I wanted to just talk about here was just who we are as Equitable and how we work with our clients. We do a lot of work in this space, and really what we try to do is we really want to make sure that we understand your situation, that we respect the assets and the hard work that you put into your companies, but also make sure we provide education to you on your options available. And that's part of the reason why we're here today working with SolderWorks in providing this presentation. So that way you guys have options and education available to you in determining what's going to be the next step for your business. How can you kind of level up your game and become a more financially viable business and put yourself on the best track for success. The next thing is making sure you track your progress in everything that you're doing. The pace of things these days moves so quickly that a lot of us forget to track certain metrics, or the tracking aspect that kind of falls by the wayside, and we're here to help with that. The last thing we want to do is provide clear recommendations to you and make sure that you understand what is on the table for you, and that you understand the options that are available, and we're here to help them. Last thing we want to do is we want to stay in touch with you all and help you guys craft a financial strategy that's going to get you through not only every stage of life, but every stage of your business. So that way you constantly feel secured and able to do what's meaningful to you. The last kind of just component that I will address here is just our process, so that way we can open it up to questions. The way we work with all of our clients is we take them through a 5-step process where we initially do just a simple discovery meeting of saying, look, let's figure out where you are in your current financial situation, identify your priorities and concerns, and present how we work, and make sure that our relationship is going to work. The next thing we want to do is just go through a profile and be able to have an opportunity to analyze your data, so that way we can move on to the strategy step and saying, look, let's present the results of our analysis and discuss some priorities and future steps for you. And then really at the end of the day, if you like everything we present, the action and review step is really where we implement, and you come on as a client and we work with you very closely to help craft a strategy and continually adjust and review that in the future. So I just wanted to kind of put that little plug in there on how we work and how we work with our clients, in case you guys, any of you all are in that situation where you're considering a buy-sell agreement or any of these other aspects, and know that we're here to be a resource for you. But with that, I mean, I'll leave this slide up here so you can see some of the other strategies and things that we work with companies for. But with that, I'm happy to open it up with questions, unless you have anything you want to add, Dan.
No, I think that you did a good job covering the last bit there. And yes, our process is what makes our organization stand out more than anything, so that we put together something that's tailored for every individual group. But definitely don't want to take up more time than we need to on recapping that. So please, any questions?
Yeah. So before anybody has any questions, both Chris and Daniel are going to be in the Slack channel. So if anybody needs access to the SolderWorks Slack, just shoot me an email, chris@solderworks.com, and then I'll make sure that everybody's there. But
Yeah.
Will, Susan, Chris, the third Chris in the channel. You guys have any questions? Anything you're curious about?
I was concerned about the insurance that you mentioned. So if I risk that, like my business partner won't have any cash to buy out shares,
Hey, sorry, Will. I'm gonna put you on mute. You had a pretty bad buzz on your microphone. Your question was about insurance. Here, I'll unmute you real quick and give you another shot here. One sec.
okay. Is that better?
It's pretty buzzy. You want here? Why don't you do this? Can you type your question in the chat and I'll kind of announce it here? Awesome. Sorry, man. That was it was just I couldn't hear a word. While Will's doing that, anybody else have a question? Susan, how have you guys thought about this at all? Out of curiosity.
Not at this stage in the company, but down the road. I mean, actually just talked to another small ed tech company this week, and I've been thinking about, that the Boulder County area has a bunch of smaller ed tech companies that are trying to get off the ground, and we'd be a lot better off if all of us just merged together. So there may be some discussion of that down the road. I know one of them is actually just getting ready to do a Kickstarter. It's the guys that have the electronic circuit boards that teach kids electronics. So there may be a possibility for really wanting to engage with somebody that understands all this down the road.
Cool.
Yeah, no, absolutely. As you look at that merger, if you go deeper and explore that merger conversation with other companies, this is exactly when this type of conversation comes up, because they look at it and they go, hey, this is what we started. This is our little company that we started. And if we merge with you, what are our rights and our share of the pie, per se, when it comes down the road of determining an exit strategy, right?
Right. Yeah, no, I mean, I think I wouldn't have a clue on where to exactly start to know what points we should make sure negotiated properly. So it would be really good to have somebody like you guys in the room to get us to understand all the ways that everyone's protected and exiting eventually, and how to really navigate that conversation.
Yeah, and that. Yeah, we're always available for opportunities like that. We're happy to sit down with groups and just walk everyone through and saying, look, these are the key points you want to consider when you're looking at a buy-sell agreement. These are the key processes you want to put in place. Whether or not you guys choose to work with us at the end of the day, we're always happy to provide that education so you guys can make the most educated business decision that's going to benefit everyone.
Yeah.
Thanks.
All right. So Will, we've got about a minute left before we're kicked out here. But Will's question was about what's the purpose of insurance. Unfortunately, I think we might have to take this to the Slack channel to answer that. But Chris, if we get kicked out, you got a minute. Chris,
yeah. Well, and so the purpose of having the insurance is that the insurance is a really easy way to leverage your dollars, right? Of saying, look, you can go and I'm going to use the example of like a term insurance policy, for example, and you can go and buy $1 million of term insurance coverage in case something were to be catastrophic, were to happen to the business, and it's going to run you, $70 a month. I mean, I don't know where else I can go and exchange $70 for $1 million benefit if something catastrophic were to happen to me or my business. So that's really the purpose that you use insurance, is that it's a really easy way just to leverage your dollars in an earlier stage. Because when you look at something like, for example, a sinking fund, do you really want to be sucking that cash flow out of your business to say, do I want to be contributing 10 grand a month to some sinking fund to try to build it up to $1 million so that way I could hopefully or maybe use it in the future to fund this agreement? And it really saps the cash flow out of your business. So insurance is a really easy way just to keep the costs low, leverage your dollars early on, and ensure that you have protection in place that will be honored in case something were to happen.
Cool. Well, thanks, everybody. I want to just direct everybody to the Slack.